What's up everyone, Professor Stefan here. I am back with another video. This time we're going to talk about the balance sheet. Let's get started. So our balance sheet reports the kind of financial position of a company at a specific date. And so if you get kind of mixed up kind of what the balance sheet is doing, what the income statement is doing, remember the balance sheet is kind of what do you have in your checking account today? How much money do you have in your wallet today? While the income statement is what was on your last paycheck, right? How much money did you make over the last 2 weeks? And so our balance sheet is going to balance our assets with our liabilities and equity. So the assets are these resources of the company that they have that are going to provide some future economic benefit. And there are people with claims against those assets. So if somebody has loaned you money, they're going to have a claim against some of those assets, and that's going to create a liability. Now, if we liquidated all those assets and we paid off all those liabilities, everybody that loaned us money, we would have some left over, hopefully. And that leftover bit is what we're going to call our equity, and that is the firm's owner's rights to these assets. So we're going to organize our balance sheet into these three sections, the assets, the liabilities, and the equity. And we're going to see kind of a split on the assets and liabilities side between current assets and non-current assets. So our current assets includes things like cash, inventory, receivables, prepaid expenses, and long-term assets or non-current assets are going to be things like property, plant, and equipment, a lot of intangible assets, some investments. And we see a similar split with our liability side between current and non-current, where our current liabilities are things like accounts payable, accrued expenses, deferred revenues, and we have some long-term liabilities like long-term debts, either loans from the bank or bonds that we've issued, that sort of thing. Now, our equity section does not have a current or long-term split, but rather that includes our common stock, our additional paid-in capital, our retained earnings, sometimes accumulated other comprehensive income that we learned about in the last class. But this equity is just the sort of residual claim after we pay off all of our creditors. So the balance sheet can be extremely useful. It helps us evaluate the liquidity of our firm, and by liquidity means how quickly can we turn our assets into cash if we need that cash for some reason. So Apple, with a kind of giant cash and investment balance on their balance sheet, highly liquid. If you see a firm, they might have high current assets, but if everything is locked up in some sort of inventory, or maybe locked up in some long-term asset, they might struggle to maybe pay off their debt because they can't convert those assets into cash fast enough. It also helps us evaluate our solvency because we can compare these assets and the liquidity of those assets to our liabilities. So we can see how quickly these liabilities are coming due. Do we have a lot of current liabilities we're going to have to pay off soon? Do we have enough liquid current assets to pay off those current liabilities? Are most of our liabilities very long term, so we don't have to worry about kind of liquidity or solvency right now? But it's going to help us evaluate kind of the position and risk of the company. Now, the balance sheet is a bit limited because we use all sorts of valuation techniques on these assets and liabilities, and they don't necessarily reflect the kind of fair value or true value of those assets or liabilities. There are all sorts of estimations in these assets and liabilities, and a lot of things end up getting excluded. So I went ahead and pulled up Moderna's balance sheet from their most recent 10Q. And you can see on this balance sheet, there is in fact no kind of intangible asset category. And so after the second midterm, we get into our intangibles and we're going to see kind of why that is. Moderna, they're going to spend tons of money on R&D expenses, and all of that gets expensed immediately on the income statement. So they don't build up this intangible asset on the balance sheet. But as you know, they have this COVID vaccine. There's probably going to be booster shots. The kind of intellectual property of this vaccine is highly valuable, but it is completely left off this balance sheet. And so again, that's one of the reasons we kind of encourage you to learn accounting, is that you can see kind of what's there, you understand how it's valued, and so you also understand the limitations of what's in these financial statements. So let's start with assets. What is an asset? It is something that the firm controls that is going to give them some future probable economic benefit. And an asset gets recognized. And let me actually pause for a second here because I want to talk about the word recognize. So this word recognize is a very important word in accounting. For accounting purposes, recognize means when you put something on the balance sheet, or the income statement. So when you recognize revenue, that means you get to book the revenue on your income statement. When you recognize an asset, you get to debit that asset on your balance sheet. It is going to show up now. And so this word recognize means it goes into the financial statements, goes into the accounting system. We're allowed to kind of show that as part of our company. Okay, vocabulary lesson aside, we are going to recognize an asset or put it on our balance sheet when 4 things occur. The firm needs to currently control that asset or future economic benefit. It needs to provide a future economic benefit. It has to arise from a past transaction. And it has to be measurable. So if any of these things fail, we are not allowed to put that asset on our balance sheet. And so this raises this important point where there are economic assets like the intellectual property of the COVID-19 vaccine. So that is very much an economic asset to Moderna, but they are not allowed to recognize it as an accounting asset. So it is not showing up on their balance sheet. It's likely the result of the measurability. So when Moderna is doing all these R&D activities, they don't know if the vaccine is going to work. They don't know if it's really going to provide a future economic benefit or how much that economic benefit would be. So that's kind of why it gets left off the balance sheet. Now our current assets, these are assets that are going to be converted into cash within 1 year or within the firm's operating cycle. And so we see things like cash, inventory, accounts receivable, prepaid expenses, and those are going to get listed in order of liquidity or how quickly we expect them to turn into cash. And so the normal order is like cash, accounts receivable is cash that we're waiting to receive from our customers. Then maybe inventory, which, takes a bit of time to sell, but it will turn over in, a few months and turn into cash, hopefully. And then things like prepaid expenses that might last a bit longer. Now, I said that this current designation depends on either 1 year or a firm's operating cycle. Now, an operating cycle is how long it takes a firm to kind of take cash, produce their good or service, sell it, and collect cash from that sale. So how long does it take them to turn kind of cash back into cash? And for a manufacturing firm, they start with cash, they go buy some raw materials, they pay their employees to produce some good, they're going to sell that good to a customer, maybe wait 30 days or 60 days and collect cash from the customer, and that would kind of designate their operating cycle. Now, for most firms, an operating cycle is less than a year, in which case their current asset kind of section is going to be determined based on if these assets can be turned into cash within 1 year. You get some firms that have operating cycles greater than a year, in which case that kind of current designation is going to follow the operating cycle instead of that shortened year. Now, non-current assets or long-term assets, these are not expected to be converted to cash within 1 year. We have a few examples of these. These could be long-term investments. You see PP&E all the time, right? Companies keep those for a long period of time. A lot of times you have intangible assets that last, more than 1 year. If you buy some patents, those could be 10, 15, 20 years. And so these are things the company is going to hold on to and not turn into cash for quite some time. So if we take a look at kind of a section of Macy's balance sheet, we see all of the patterns we just talked about. We have a current asset section, we have a non-current asset, non-current assets below those. They don't separate them into kind of a non-current section, but they're all listed together. And we see the current assets listed in order of liquidity. So we've got our cash, we've got our receivables, we've got our inventories, we've got our prepaid expenses and other assets. So it's exactly what kind of we just saw previously. Okay, so let's get into liabilities. Liabilities are claims against our assets by our creditors. And creditors are just people that loan us things. In a lot of cases, this is cash, so it could be banks, it could be bondholders, they've loaned us money. Also, very frequently, it could be our suppliers, right? If they sell us inventory, a lot of times we collect that inventory and we don't pay them, we don't pay the cash for that inventory until 30, 45, 60 days later. So they have loaned us inventory in essence. And that's going to create a liability. Now, the key distinction here is that these creditors are not owners of the firm. So that's kind of what separates liabilities from equity. Now, a liability is going to be recognized. It's going to be put on the balance sheet when there is a current obligation. So you do currently owe that money. The obligation arises from a past transaction. So something has happened to generate this liability. It's going to require the sacrifice of a future economic resource. So some sort of asset you'll have to use to get rid of this liability. And the liability is measurable. So it's a very similar definition to what we saw for assets. And again, just like assets, we split them into current and non-current, and it's going to follow the same rule where current liabilities are those that are paid off within 1 year or within one operating cycle, and non-current liabilities are those that are going to be paid off kind of more than 1 year out. And so we see accounts payable, accrued expenses, deferred revenues, all of that stuff in the current category. Then in the non-current liability category, we see things like long-term notes, bonds, pension liabilities, that kind of stuff. Now, one important thing here is that long-term notes or bonds could be split across both categories. If you're making quarterly payments on a loan, the next 4 quarters, kind of what happens in the next year, is going to be a current liability, and the payments that are going to come more than 1 year out are going to remain long-term. So it could be one loan, but it gets split in the liability section on our balance sheet. So if we take a look at Macy's balance sheet here, their liability section, we see what we just talked about, where we've got our current liabilities listed in order of liquidity, how quickly we expect to pay them off. So we've got short-term debts, we've got accounts payable, we've got accrued liabilities, that sort of stuff. And then below the current liability section, we're going to list our long-term liabilities like long-term debt and some deferred income tax liabilities. So closing thoughts, big important points here. Our assets and liabilities are split into current and non-current portions. These assets and liabilities are listed in order of liquidity, especially in that current section. And very, very importantly, not all economic assets or liabilities are recognized on the balance sheet as accounting assets and liabilities. So that's a big part of this class, is understanding what goes onto the balance sheet and how it's measured. Thanks for watching.